In this video, we're going to focus on savings in terms of money management, because savings are a very important form of money management. There's two big benefits. One, of course, is the income you derive from it. The other one is the capital appreciation. So we're going to look at ISAs, savings accounts, shares, stocks, bonds, real estate investment trusts, and also property. So I'll cover those 6 for you in this particular video, just to get you started so you can start thinking about which one might work best for you. In this episode of money management, we're going to be looking at savings. In the previous ones, we looked at money management itself, and then also credit. And in future ones, I'm going to explore different areas, but this one is focused on the traditional savings that people can usually have, and then subsequently later on I'll then go into more details in other forms of savings you could do on a separate video. So one of the main savings out there is called an ISA. It's an individual savings account, and there are different types, and you can also have junior ISAs for your children, which is good. And money can only be added to one of each type of ISA per tax year. So there's a limit to it, and any income that generates is tax-free. And ISAs can be opened in a variety of different ways with a variety of different providers. So you've got banks, building societies, credit unions, stockbrokers, and money can be withdrawn from an ISA at any time, and ISAs can be transferred between providers at any time of your choosing, which is good. Now you'll be thinking about, well, how much can I put into my ISA? It's up to £20,000 every single year, and that can be spread across the 4 different types of ISAs. Now, to qualify for the cash ISA, an individual must be 16 years or older and a resident of the UK or Crown servant. Cash ISAs can include savings in bank and building society products and some national savings and investment products. So it's pretty good. To qualify for the stocks and shares ISAs, the individual must be 18 or older, again a UK resident or a servant of the Crown, or a Crown servant. And you can have significant tax benefits for those who are higher or additional rate taxpayers. Investments in stocks and shares ISAs are exempt from dividend tax and capital gains tax. So that means obviously you won't pay anything when you get rid of it, and when you derive any income from it, there's no tax to pay on the dividend. Another type of ISA, which I think is quite interesting, is called the Innovative Finance ISA, and this contains peer-to-peer loans, and this is basically for investors willing to lend to borrowers, and it cuts out the bank in the middle. It's quicker, easier, very popular, done all online. I've had quite a few clients draw down loans through the peer-to-peer funding option, and it is quick and flexible. Not the cheapest, but what's important, speed or the cheapest rate, and that's something that you need to balance, which is outside the scope of this particular video. So the interest rates tend to be higher because obviously there's higher risk involved, because things move quickly, whereas obviously if you go to a traditional bank, they take quite a while, then they do all the searches on you, all the background checks, making sure everything works okay, and then they give the loan to you. This works quicker, so the attitude towards risk is very different, therefore they charge you higher for the privilege. And then finally, you've got your lifetime ISA, which was launched in 2018 and can be used towards paying for a house, or used towards paying for a deposit on a house. But it has to be a house worth less than £450,000, so that's quite important. And to qualify, an individual must be between 18 and 40 years of age at the time of opening their particular account, and they must not have owned any kind of property before. Individuals can save up to £4,000 a year, and the state will add an additional 25% to the account. That's 25%. Pretty good going and pretty helpful for those first-time buyers. And there is also interest on those accounts, and this can be applied after the state addition is added, so even better. But it is necessary to take out the money of the ISA for usage on something other than a deposit or pension, and a 20% fee is applied if you do that. So those are your 4 different types of ISAs. You've got the cash ISA, you've got the stocks and shares ISA, you've got the innovative finance ISA, and then you've got the lifetime ISA. And you can mix and match. You could do £5,000 in each if you wanted to. So that's that. Alongside that, you've then got your traditional savings. So up to the first £85,000 per person is protected by UK regulations in any one particular bank. If that bank goes bust, if you've got more than £85,000 in an account, then that isn't protected. So you might, if you've got, let's say, double that, so if you've got £170,000, you might want to put £85,000 into 2 different bank accounts. Now, basic rate taxpayers can earn up to £1,000 on interest per year tax-free if they don't have any other savings income. If they do, then obviously that gets added on that onto the total amount, and you'd only get the first £1,000. If you're a high rate taxpayer, the first £500 of savings income is tax-free. And if you're an additional rate taxpayer, then you don't get anything whatsoever, but you are earning £150,000 or more, so £500 or £1,000 isn't as significant to you as it would be for a basic rate taxpayer or a high rate taxpayer for that matter. And easy access to accounts allows the owners to access their funds at any time, but you obviously have lower rates of interest. Then you've got fixed rate savings accounts which offer higher rates of interest, but then you lock away your funds in that account for a longer period. It could be 6 months, could be a year. So the longer you keep your money in, then you give the bank certainty, the more or the higher rate of interest they'll give you, but then you've got to give them quite a bit of notice, so you're not going to be that liquid. If you need the cash urgently, then you might not want to put it into a fixed rate savings account. You've then got regular savings accounts, which means you have to put away a certain amount. It's between 200 and 500 every single month. It's good for habit building. If you listen to the first episode in this particular series where I talked about budgeting, so if you wanted to budget and tighten up on your expenditure, you could say I want to put £200 every single month towards this particular savings account, and the balance builds up. But on another episode in this series, I talked to you through debt and also paying interest on a mortgage. So if you own a home, what you could also do is pay £200 extra every single month towards that mortgage, so you pay less interest over the term, but also pay off your mortgage quicker. So those are 2 options, and you'd have to weigh up which one works better for you. Above and beyond those savings, then you've got investments. So investments can be made pretty much in almost anything, but the most common ones, generally speaking, are shares, bonds, and the property market, and they are best suited for usually long-term financial growth. I know some people go short on shares, and then you've got crypto and all of that, but generally speaking, when people invest money in there, especially people who are risk averse to some extent, will kind of go into the FTSE 100, say, and go for the safer investments. But you don't have to go for the FTSE 100. There are other options available to you too, which I'm not going to cover on this particular video. But alongside this, of course, you can also make an investment in a business. So you could either enter into some kind of a joint venture on a one-off project, or you could be a silent investor, or you could invest and then obviously work in that business too, therefore or thereby creating an additional stream of income. And depending on how much money you've got, you could, let's say, invest £20,000-30,000 into 2 or 3 or 4 different businesses, and then rely on some return on investment, which could work well. And if you're diversified by investing into 4 different types of businesses, you spread the risk, and hopefully you'll make some money from all of them, which will be good. But even if you make good money on one of them, average money on another, and 2 don't work so well, you're still going to be pretty well off, hopefully. And investments can bring in high returns, like I said, but that does come with risk. So you'll obviously know that the higher the risk you take, the higher the return that should be available. It doesn't always work like that, but that's how generally the system works. But there's no guarantee that obviously you're going to get a good return, and there's no guarantee that the value of your investment is going to go up either. But most investing products have fees and charges associated with them, so make sure you do check out, especially if you're going to a broker or an online provider like, say, Vanguard, for example, or Hargreaves and Lansdowne. They'll have different fees, and depending on how much money you invest with them, I think with Vanguard, if you've got £250,000 invested, they don't charge you any fees. With Hargreaves, I think it's £1 million. That once you go over that, they don't charge you any fees. But work out the fees and then the return to make sure it works out for you. But the typical charges include investment management charges, admin fees, platform fees, entry costs, exit costs, and there are websites where you can find different types of funds. So make sure you take all of those into account when you work out what kind of a return you're going to get. But due to the widespread of the internet and the investments available, and also the investment scams, it's become more and more common now for sometimes people to invest online, and they might get scammed. So be careful, you stay away from those scammers. So it's important and imperative that you check with the FCA register before considering any investment to ensure that it is a legitimate company. So like I've used two of the common ones that I know of, Vanguard and Hargreaves, they're okay, but there are plenty others out there. I'm not looking to promote any one of them because I'm not offering financial advice, I'm just sharing information with you based on my own experience. But make sure you do your due diligence and your checks, because I have known people who have got stung and then you can't get the money back, I'm afraid. So nasty world in terms of some people out there who would just want to prey on people and scam them. So we all want to make sure we stay away from them. Now, above and beyond that, you've got shares, and most people who invest do so through the stock market. They buy shares in companies with the aim of obviously making some kind of a return, both possibly in terms of a dividend payment depending on how much they invest, but also with the value of the stock going up. And shares can be traded in the UK, of course, on the London Stock Exchange, and the greater the return that you desire, the greater the risk involved, but we will kind of very quickly cover that. And there are two ways to profit from shares. One obviously is when you sell them, and the other one that usually is obviously when there's an increase in value because the company's done well, and the second one is when you get a return on your dividend depending on how much you've invested. And the FTSE 100 includes the largest 100 companies by share capital on the London Stock Exchange. Above and beyond that, you've then got bonds, and bonds are a loan from an individual to a company or government. Usually governments use this quite often, but unlike stocks, they do not give the same individual loaning the money any stake in the company. So you will not benefit from the company growing, but also you don't lose out if the company doesn't do so well. So the risk is lower, and therefore they return lower rates of interest as compared to investing on the stock market, but you've obviously got less risk and more assurance. And investing in a government bond, as you can imagine, is lower risk, and when you do so, you get a lower return as well. Short-term bonds are also they usually have lower rates of interest, but again, if you wanted to diversify and put a bit of money into bonds and get some return, it is a pretty safe investment. And then my favorite of all, of course, is property, and that I've covered elsewhere on this particular channel, and I will continue covering it. But if you're looking into property, then there are a variety of different options available to you. You can invest in real estate investment trusts, REIT, or REITs, depending how you want to pronounce it. And then you've got buy to let, or you can got buy to hold, or you've got flips, or you've got commercial conversions, you've got rent to rent, you've got serviced accommodation. You can then just be a managing agent or a letting agent. You can then do joint ventures. So it's a long list of all the different things you can do. And property is exciting, interesting. You can obviously buy land and obtain planning by going into speculative deals, and I'll talk about that somewhere else because I've done a couple of those myself. Or you can buy land with planning and then build houses and keep them and sell them. So the possibilities are numerous. From all of those, personally, I prefer property. I like property. It's challenging, that every deal is different, you meet different people, funding requirements are different, every project's different. And if you want to look at some of my projects on here, you'll see one I've done, a 21 flat development in Boston. We've done we're just doing now, in fact, 12 flats in the New England Club, and also 5 flats called St. Paul's. All of those videos will be up here somewhere, and you can find them and have a look, and I'll share with you there how we found the deal, how we funded the deal, how we're going to refinance the deal, whether we're going to hold, we're going to sell. So there's plenty on property available to you. If you've been through this video, I hope you've liked it. Click the like button so I know you've liked it, so I can share more of this type of content with you. Also, please subscribe so that you'll get notifications of all the videos that I send out to you, and post comments in terms of any questions you've got, and also post comments in terms of the type of content that you want to see. Then I'll make sure I deliver that. But just to be clear, this video is just sharing my own experience with you. I am not qualified to give you financial advice. None of the content here is financial advice. It's just me sharing what I know with you. So if you are looking to make any investments, please speak to a financial advisor who can guide you more on what to do and what not to do.